Addicus. We appreciate all of you joining us, spending some of your valuable time this evening. I'm going to introduce everyone, give a quick outline, and then we're going to get started with our latest payroll protection program and SBA guidance call. Chad Webb from Addicus will be on here covering several topics. Brandon Dixon, our general counsel, myself, obviously, and Andrew Adams will be the speakers. Our agenda, we're going to cover some notable items, updating the SBA guidance. We're going to have Brandon spend a little time on the economic injury disaster loans, the EIDLs. I know a lot of people have reached out and applied for those loans, but haven't had a lot of movement. So we're gonna have an update there. Then we're gonna spend the bulk of this conversation around the payroll protection program. I know a lot of you have applied. There have been a lot of people on the phone who have received their loans. I know that probably everybody on the phone realizes that the SBA announced today that the program has run out of the $350 billion. So there are some people who have not received their loan yet. We feel very, very confident that there's another $250 billion coming, and we'll be talking about that. But that's what we're spending a lot of time on forgiveness, balancing, forgiveness with liquidity, things like that. The fifth thing we're going to talk about is really net operating losses, and for some of you, it may make sense to spend some planning and go back, and there may be some previous year's tax returns that can be filed, and you can get some nice tax refunds. The last thing we'll talk about is our capabilities, positioning, and what we're here to help with. So I'm going to pass the baton to Brandon and he's going to spend a little time on SBA guidance update.
Yeah, thank you, Stephen. So in the last week, we had a round of guidance that was issued by the SBA. This is the third interim rule that they've submitted. This supplements the prior to interim rules that were issued on April 3rd. Before that, I'm sorry, I think I actually skipped, just to clarify, the rules, there's been a lot of question about what's applicable, what's not. The rules issued by the SBA are authoritative, and they should be followed. And in the absence of contrary guidance by the SBA, we recommend that you follow that guidance. With that said, a lot of these programs are going to depend on, there's a lot of gaps in the rules, and that's going to depend on the banks. With respect to the guidance issued on April 14th, it mainly covered the application of the PPP program to self-employed individuals and partners in partnerships. Self-employed individuals are eligible for the PPP loans. The eligibility is based on earnings from 2019 and is capped at $100,000. So they're looking to actually the net earnings as reported on Schedule C. That's important because they are going to require you to provide a Schedule C or other sufficient documentation. The loan is calculated as the average net profit capped at $100,000. That's divided by 12 and multiplied by 2.5 to gain that annual equivalency. Again, you do need to provide a 2019 Schedule C or tax return with Schedule C to support the loan. If you have not filed that, you can file you can provide an unfiled copy. Forgiveness for the owner is based on compensation. It's based on the 2019 profit of the business. This is important. Although a business, that was, or an entity or a business or an individual that was employed in business on February 15, 2020 is eligible, the amount of the loan is capped based on compensation for 2019 and income for 2019. That's important because if the business did not have income in 2019, then they're not going to get anything. So it really does limit it to effectively businesses and individuals that were in business during 2019. For partnerships, the calculations are basically the same. One notable aspect of this is that the loan for a partnership includes the amount for the partners. So the partners can't go out and get individual PPP loans for themselves. The calculation differs a little bit depending on whether you have the partnership has employees or not. If the partnership has employees, then the net income from the partnership is capped at $100,000. You add to that the payroll costs that are included for all employees, and then you add the refinanced EIDL loans to the extent that those loans are included. And if the partnership did not have employees, then that calculation is simply based on the net income. One other important note is that employee benefits for owners are included in the calculation of the loan, but they're not included in the forgiveness portion of the loan. So that can cause some asymmetry there. Moving on to the next slide, the economic injury disaster loans. This was another program that was established by the CARES Act. This preceded the PPP loans, and many of you and many of your clients probably applied for this loan. It's really kind of been a black box to this point. People submitted the applications and requests for the grants, and to this point, there's been very little communication regarding these loans. I don't know of anybody who has actually received this yet. The CARES Act actually provided that an eligible business would be eligible for $10,000 advance on the EIDL loan. The SBA subsequently limited that in their guidance by interpreting that provision to mean that it was up to $10,000. Effectively, the SBA has stated that it will only provide an EIDL grant to business with employees, and then they will only do so at a rate of $1,000 per employee with up to a maximum of $10,000. This position, it frankly conflicts with the CARES Act, the plain language of the CARES Act, but in effect, it is what it is. Unfortunately, there's not much that could be done about that at this point. There is no guidance on whether you can have both a PPL and a EIDL loan. The CARES Act does say that you can have a EIDL. It does contemplate that, but it also indicates that you cannot have a EIDL loan for costs that are covered by a PPL loan. So it looks like there is some exclusion. Again, we don't know about the interplay between those two. At this point, I'm going to toss it back to Stephen to talk about some of these discrepancies between the CARES Act and Treasury guidance.
Thank you very much, Brandon. Yes, the Payroll Protection Act and the CARES Act, as we look at this, the Payroll Protection Program, according to the CARES Act, is intended to cover 2.5 months of eligible payroll costs. The interesting thing is when we looked at that, the maximum duration of the loan is 10 years for any unforgiven amount of the loan, and then ultimately the forgiveness of these loans using any 8-week period. Well, that's what the Payroll Protection Program and the CARES Act said. Ultimately, the guidance, as you look at that, it says the clock starts on the 8-week period of the origination date of the loan. And as we have looked at this, what we understand the origination date to be is the date that you go to the bank and sign the loan documents and you are funded. So on that date, an 8-week clock starts. And as we talk about the things later in this presentation, realize that the clock has started then, and everything we're going to talk about has to happen in that 8-week period. Lenders are advising that the borrower must take funds within 10 calendar days. Again, there was a lot more leeway in the act, but when the SBA came out, they told the lenders, when you get your SBA loan approved, there's a 10-day window that you have to get to the bank and sign those documents, and on that day, the 8-week starts. And then the last thing, which again, I don't think is going to create a large problem for most folks, but instead of being a 10-year term for the loan, what they have said is for 6 months, you don't have to make any payments. After that, there's a 2-year loan total. So you have 18 months following that 6-month period to actually to pay your loan off. So those are some of the differences between the two programs there. As we move through, that's been one of the things that I would say has been most problematic and has given us the most headaches. So we move to the next slide. This was something as we have really looked at, and I think there, if you hit it one more time, I think there's a graphic that may pop up here. Yes, there it is. So as we look at the program, really as business owners, there are two things and two categories that our business owners fall into. The first one is business owners who want to maximize forgiveness, and they say, and somebody's got some noise in the background they might want to mute. So business owners must balance forgiveness with their objectives. There are business owners that say, hey, you know, I've got all my employees here, we're all working every day, I'm running payroll, and I want things forgiven to the max. There are other business owners that say, hey, I've got people who aren't here, and people who, there's my graphic right there, people who aren't here, and I don't know when they're going to be here, and the business is on life support, and I've got my PPP loan. So what's my decision here? What are the things that I need to go through in my mind to make a decision? So we've got business one and business two. Weekly income of $200,000, weekly 8-week operating expenses of $75,000. Business number one is the business where, hey, I have let my employees go, and or I have let a number of them go, and I'm running a more of a skeleton crew. And what I've done is I've gone out and taken out a $200,000 PPP loan. You'll see that PPP proceeds $200,000. Business number two is in a slightly different situation. Their 8-week income that they were able to do their calculation off of, they've got their operating expenses 75 grand, but their payroll is higher. They've retained their people. Again, they have the same $200,000 PPP proceeds. So as they move through this and they spend, and both entities spend their money down, the entity on the right, business two, was able to get maximum forgiveness. So their net cash position ends up being $135,000. The net cash position, because again, their payroll was less in business one, they have $235,000 net cash position. They were only forgiven 75 grand because that was the amount that they were able to forgive, versus the other business owner was able to forgive that 175 grand. And here's why we went through this exercise. Basically, business owner one is going to have more cash in their pocket. That person may end up needing that cash for other things, but now they've got a loan on their books. Their other business owner had it totally forgiven. The net equity position in the business is exactly the same. So while we believe most people that keep on the majority of their employees are going to want to max out forgiveness, what we're saying is, from a business owner perspective, from a net equity position in the business, if you don't have the loan forgiven, you've still got the cash on the books. You could pay it off the next day if you wanted to. But if you're looking to maximize flexibility in that 2-year period, you have to pay the loan back. What we're saying is, from a net equity business owner perspective, if it's mission critical for you to keep cash, then keep the cash. So with that, we're gonna move to the next slide and talk specifically about forgiveness.
Thanks, Stephen. And just to kind of touch off that point, I think that's a point we've been making to our clients is, as you can see in that slide, bringing back your employees, while noble and great to take care of them, really doesn't help the business owner. So we want to make sure people stay focused on keeping the main thing, which the first main thing we've talked about many times is sustaining this crisis, survival, and cash is going to be key, to do that. So kind of moving on, a couple things that are working against us relative to forgiveness. Stephen touched on it earlier. This, starts with the loan calculation being a 2.5 month, maximum period, which really works out to be about a 11-week period. The problem is that the forgiveness period is only an 8-week period. So really coming out of the gate, you're really already underwater in terms of getting that maximum forgiveness. So you're going to have to be very thoughtful in terms of if forgiveness is your main thing, you have plenty of cash, plenty of staying power to keep the business operating. You're really already underwater coming out of the gate trying to get that maximum forgiveness. Second, when we calculate gross payroll for the purpose of forgiveness or the purpose of calculating the maximum loan, included in payroll, we included gross payroll. So we included federal income tax, Social Security, Medicare, and FUTA, federal unemployment tax. So all of these things are withdrawn from your employees' paychecks. And the problem is that on the back end of that, we'll talk about this a little bit more later, you are not yet able to count that as eligible payroll. So for example, if you pay an employee $5,000 a month in gross payroll, when we calculate the maximum loan, we use $5,000 as the factor for that particular employee. If you pay that employee a $5,000 gross payroll and through FICA withholdings and federal income tax withholdings is reduced down to $4,000, $4,000 is all you can count for the purpose of forgiveness. So you've got several things working, against you. So we'll be looking for creative ways to elevate eligible costs, and I think that's where the magic of this program is not to going back to the previous slide, not to spend all the money hiring employees and paying them to really not change your overall balance sheet position, but things that you're going to do anyway. Can you advance certain payrolls? Can you advance pay rents? We're going to talk about a little bit of this. Cam, if you're going back to the next slide. No, I'm sorry, slide 7. So again, there are a number of things that are working against you. The other thing is the SBA, and this is really where this conflicted, some of the guidance provided by the law and the guidance provided by the SBA seems to be different. One of the things the SBA has taken a very hard position on is that this loan will only be forgiven based on 75% payroll and no more than 25% of other eligible costs. So again, you may have rents and mortgage interest and utilities and other things that would be well more than that 25%, but the SBA is limited to that 25%. As far as how we achieve forgiveness, there's still a ton of uncertainty relative to that issue. We really only we were hoping this most recent SBA guidance that came out would give us much more clarity around how you achieve forgiveness. We know some things from the law. That's really all we have to rely on. If you'll go to the next slide, Kami. So the first thing is we've got a couple of items in addition to the fact that we're behind the 8 ball as soon as the 8-week period begins, because we have an 11-week period we calculate a max payroll on, and we have an 8-week period to achieve forgiveness. In addition to that, we have a couple of potential reductions, and to be quite candid, and this drives people like us crazy, we do not know exactly how this works because there's absolutely no guidance. And unfortunately, what we're likely going to find here is that we're going to get that guidance midstream of this forgiveness period. We hope to get it the next week or so, but there's been no announcement as to when we can expect that. But the first item of potential reduction in that forgiveness is your full-time equivalents. So if your full-time equivalents before this all began was 30 employees, if you have less than 30 full-time equivalent employees in the 8-week period, you're going to receive a reduction. I've seen calculators and articles out there that say it's based on the percentage reduction, you reduce the amount of forgiveness by that percentage. There's nothing in the law that states that. You do have the benefit of choosing the testing periods that you're looking at. Your kind of your base case. You could either look at February 15th, 2019 through June 30th of 2019, or you can look at January the 1st of 2020 through February 29th, and you get to pick the lower of the two. So if you had less employees in January than you did the previous year, you would obviously want, you'd all obviously focus on that January 1st, 2020 time period. Alternatively, if you're a growing business, you may want to look back at the February 15th, 2019 to June 30th, 2019, because your full-time equivalents may have increased through the year. The second payroll cost reduction is on an employee by employee basis. And I'm going to kind of relate these two because they do intertwine, and we do not know if they're additive. In other words, is it both and there's some compounded reduction, or are they somehow tested independently and nobody has come out and said it's this or it's that? But the way the payroll cost reduction is you throw out any employees over 100,000, and you also throw out anybody with commissions or variable compensation. And what's left, you look at it on an employee by employee basis. This is also another place that's confusing. You look at the Q1 2020 payroll for that particular employee. So take Joe. Joe was an employee during the period. Joe earns $6,000 a month. And that's what his Q1 2020 wages are. To the extent that I tell you, let's make it $4,000 a month to make math easy. So he earns $4,000 a month. He has got to earn at least $3,000 a month in order to not trigger a reduction. So if it's 25% less than the previous period or more than it exceeds that 25% reduction, you start to kick into a reduction. So, and Kim, if you'll flip the slide, we'll kind of run through a couple of calculations on this. So on the left-hand side of this slide, you're going to see a number of FTEs on the two periods. So you see this February 15th, 2019 through June 30th, 2019, we had 30 full-time employees. And that is full-time equivalents. Again, we don't know the definition of how they intend to view full-time equivalents. That's another area of concern, and there's a question mark around that. And then in the January 2020 to end of February 2020, we had 25 employees. So we used the 25 employee threshold. And our testing period is May the 1st through June 30th. That's roughly an 8-week period. It's probably actually a little over 8 weeks. We have 20 full-time equivalent employees. So we're at 80%. Again, some calculators say, well, then effectively what you do is you reduce the eligible forgiveness by 20%. The second test, which is the wage test, is calculated on an individual employee basis. So you effectively have a census of employees. You look at your 2020 wages. So taking the top employee, they earn $5,000 per month. It was their average pay rate or wage rate. If you skip over to the third column, they have to earn at least $3,750 to be above that 75% threshold. They didn't. They were at $2,500, so therefore there's a $1,250 reduction. Again, here's where there's several questions that we have. Number one, do you take Q1 2020 and come up with average gross wages? There's nothing that says that's the way you do it. That's what the consensus seems to be, but it's educated speculation at best. And then the second part is on the reduction. That reduction only reflects 1 month. So do you take those numbers and multiply them by 2 to reflect the entire 8-week period? Nobody knows the answer to that. So we'll talk about here in a moment, some strategies that we intend to employ. Again, not knowing the definitive guidance of how this, is supposed to work, that could help with this. The challenge is going to be, is it appears now on the full-time equivalent test, that's not relative to a single individual employee. So if you had 20 and you have 20, if you had 20 before the period and 20 during the period, you're good. The problem that we look to potentially run into is if we terminated an employee, and it could have been for good cause having nothing to do with COVID, and we hire a new employee, how does that affect this reduction? Do we get credits back for we get a reduction for the employee that's no longer there, but do we get credits back for the employee that we've added to the period? And nobody really knows the answer to that. Let's move on to the next slide. So talking about things that we're thinking about doing in terms of achieving forgiveness, again, eligible payroll costs is up to 75% of the PPP loan. Here's another issue where we really lack guidance. Can it exceed 75% of the loan? You would think that you could, but nothing says you can. We do know there's a hard and fast 25% limit on the non-payroll eligible costs, i.e. rent, utilities, mortgage interest, etc. But in terms of maximizing eligible payroll costs, here are some things that you can think about doing. You could always change your mode or frequency of payment. So some of the things we're looking at with our clients is looking at exactly when we pay payroll. Do we pay it weekly? Do we pay it on a specific day of the week? Do we pay it semi-monthly or monthly? Or do we pay it every 2 weeks? Or how do we pay it? Can we change frequency? Can we potentially advance a couple of payrolls and then maybe suspend payroll in July to offset that? Seemingly that's allowable. Nothing says at the moment that we can't do that, but that would certainly elevate our eligible payroll costs. If we're intending to give employees bonuses, can we potentially go ahead and pre-fund some portion or all of those bonuses? Nothing seems to prohibit adding other family members to payroll, spouses, children, extended family. If there, obviously there needs to be strategy behind doing that, not just paying out money to pay out money. Can we bonus other partners or family members? Again, there is this $100,000 cap, so you need to be careful about doing that. And you can fund employer-sponsored retirement plans for your 2019 contributions or even some of your 2020 contributions if you're still intending to do those things. But keep in mind that is not for owners. Owners cannot participate in that. Now, that was one of the big revelations of the most recent SBA guidance, is that they took the position that employee benefits relative to forgiveness do not include owners. So that means owners' health insurance can't be included, owners' retirement contributions can't be included, or other group benefits such as disability, group life, vision, dental, etc. In terms of non-payroll eligible costs, you could go ahead and advance, or catch up deferred rents, especially if they're related party. Nothing seems to prohibit a related party rent. So, for example, we lease several buildings to our company. We certainly could go ahead and not increase our rent, but go ahead and pay, a few months early. They may come out with guidance that says we can't do that, but right now they have not. Oftentimes you pay triple net rent and you have some, CAM charges, or you have charges for insurance or taxes, maintenance, repairs, other things. You may want to go ahead and advance some of those payments. In addition, utilities is a little bit broader term. It's a defined term in the Act. It says utilities includes water, gas, electric, phone, internet, and one item that was left off here includes transportation, whatever that means. That's not a defined term in the Act. But you could go ahead and prepay some of these utilities and just have it credit on your bill. If you know you're going to continue to pay up the $500 a month electric bill, you may go ahead and pay 3 or 4 months of it. So these are some things that can be done.
Drew, I just want to add to that the interim rule that came out on April 14th actually clarified that the meaning of some of these categories are broader than what we initially thought. So, for instance, rent would include not just real property, but also personal property such as equipment, and could include, in some cases, vehicles. So just be mindful of that.
Thanks, Brandon. And perfect timing. I think you're taking over.
Yeah. So moving on, one of the questions that was raised initially is how do we account for the PPP funding? And this is important, really, given that we have to show that the funds were used for specific purposes in order to achieve the forgiveness that we're looking for. A number of people are advising clients to open a separate bank account and to use these clients and to use this account to track the funds and payments out of that. Really, after looking at that, it may not be a workable solution. Most clients already have their payroll set up and have ACH payments set up for vendors, and it would be difficult to actually reroute that to another account. What we're advising clients to do is to park the funds in a separate account and utilize those that account is basically a holding, a vehicle to hold the funds, and then reimburse the accounts from which the funds or payments are made in order to track those.
And Brandon, this is Drew. Just want to touch on that point. I don't want folks to get too enamored with that point. If you do or do not open up that account, the analysis we went through is looking at that account and saying, what good is this really going to do to support our forgiveness? And the problem that we ran into, while it sounds logical to open that separate bank account, is that your payroll, a lot of these eligible costs are all on auto draft with your payroll services and other things. And we started worrying about, well, we start switching those drafts, and then we're going to, yes, we can show an account statement that shows all these drafts and payments out of the account. And when this is all over and that money is run dry, we're going to have bounces on our ACHs and things like that. And the reality is, unless you can move everything over and pay it directly out of the account, you're still going to have to provide supporting evidence. You're going to have to provide payroll reports. You're going to have to provide rent checks and other things like that. And so it just seemed almost more logistically burdensome than the benefit that it would provide. So I think it's an okay practice to do, but I don't think it is not mandatory or necessary.
Yeah, I think record keeping and maintaining a good, clean record of the use of funds is really more important and probably more practical. We want to touch on, moving on to the next slide, an important aspect of this is the tax treatment of the forgiveness. And normally, if a debt is forgiven, then that would constitute income for tax purposes. The PPP or the CARES Act, I should say, actually specifically provides that the forgiveness, the income from the forgiveness, is excluded from income for tax purposes. So this is really this is very important because a business is not going to be hit with income, but the expenses that they pay with a loan will still be deductible. And so it's really a holy grail there where you get the benefit without the burden of the income. So take, for example, if you get a $200,000 loan and expend $200,000 on allowable expenses, then that's going to be forgiven. That's going to create a tax loss, and you're not going to have income for tax purposes. It should be noted that for pass-through entities, this could affect capital accounts. And in the case of S corporations, this could affect AAA. So for accountants out there, this is something to note and come back to. But this really is a big advantage of the PPP program.
And for business owners specifically, who especially take distributions out of their partnerships or out of their corporations, they just need to be very mindful. A lot of these businesses run very tight on their earnings relative to their distributions, and you could find yourself with a taxable dividend if you're not careful and manage it properly.
That's right. In addition to the PPL, a lot of focus has been on the SBA provisions of the CARES Act to this point, and rightfully so. But there were a number of other provisions that augmented the loans and the grants that were provided by the CARES Act. One of the more important provisions is for pertaining to NOL carrybacks. The CARES Act created the opportunity to carry back losses for 5 years, and these losses arising in 2018, 19, and 20 can be carried back for a period of 5 years. So a loss in effect from arising in 2018 could be carried back to 13. That could be used to generate a refund and then carried forward accordingly. That, when added to the additional depreciation and the other provisions of the CARES Act that allow for bonus depreciation and expensing of qualified improvements could generate an additional loss that could be used to generate a refund. And so you should go back and carefully analyze returns to determine whether you can monetize that loss by carrying back the loss to prior years. And we have an example here just to show how beneficial that could be. In addition to the NOLs, a additional provision, the CARES Act, eliminated a modification that limited losses, the use of losses, to taxable income. And so for the years 2018 through 20, which means that you can amend returns, those losses could exceed taxable income and generate additional refunds.
And Brandon, one important note here too is really a couple of things. One is because of the way the carryback of the net operating loss works. So let's take this business as a $7 million of taxable income in 2013 through 17. They have a $5 million loss in 2018. They can take that back and get refunds from years 2013 through 17, beginning with your oldest year first. But an important point that this slide kind of cuts off is the tax rate changed in 2018 for C corporations, for example, to 21%. The old C corporation tax rates were 35%, and in some cases north of that. There's kind of a little bit of a bell curve to the tax rate. And so by carrying that loss back, number one, you're getting some cash today, so you're increasing the net present value. But number two, you're actually increasing the real value of the loss, because a dollar of deduction used at 35% is obviously worth a lot more than a dollar used at 21%. So that's an important note to make.
Correct. And procedurally, it is important that this be done in a timely fashion. The CARES Act went back and included provisions to reopen the statute of limitations and allow taxpayers to go back and file amended returns and claims for refund. But those claims have to be filed in a very short period of time. You have 128 days effectively from the date of the enactment of the CARES Act to do that filing. Those claims, bottom line is that if you're going to benefit from this provision, you need to act now and look into whether that's feasible.
Thank you very much, Brandon. We definitely have some time for Q&A. And I meant to say this earlier. I know a lot of you have been on the call. If you have some questions, I know we've had some submitted already, I believe. Feel free to put those in the chat section of the GoToWebinar column on your right. And Cammie, I guess I would reach out here in a second and we'll go through some questions, but just wanted to let everyone know. And again, I know that a lot of you have been on our calls before. We're here to help. If you've got any questions or thoughts, or you want us to discuss your situation, you will all have our contact information sent out to you at the end of this call, and we're more than happy to have a conversation. We are working very hard to stay on top of this shifting sand that is the law and then is the regulations. As I said earlier, we feel very strongly. I know Brandon was on a call earlier where Mitch McConnell was talking about getting this next $250 billion through. Everyone feels very, very strongly that is going to happen. Both sides of the aisle want to do that. They're fighting over how much extra money gets thrown in there. So our grandkids will be paying for that later on as well. So we're staying on top of this. We're working in real world situations with our families and working through these problems. So feel free to reach out. What you're dealing with, we may have already dealt with and may be able to help you very quickly. So more than happy to do that. Cammie, I'll toss it to you a little bit and we can moderate some questions.
Thank you, Stephen. We've got several questions from clients, friends of firm, and other attendees. I'll jump right in. Here's a question. Can the PPP be used to pay for the company professional and general liability insurance? It is required to cover our healthcare staff.
Brandon, do you want to take that one?
Yeah, so the PPP, it it could be used to cover that. There is it's allowable to pay other expenses, but unless the expense falls into the categories specified of payroll costs, rent, utilities, mortgage, or interest, it is not going to be a forgivable expense. So while that is a necessary expense of doing business, as defined, I don't believe that would qualify as a forgivable payroll cost.
Okay, thanks, Brandon. Question, our payroll date was one day after our PPP loan was funded. Obviously, that payroll covered work days before the funding. Can we use PPP loan money for this payroll and be forgiven for that?
Again,
so I assume that
the guidance is still not super clear about this, as we've talked about throughout this discussion today. But I believe absolutely that counts, because it's going to show that the records for your payroll is going to be one of the things that's used to support the forgiveness. And the fact of the matter is, it's going to show you had the loan date on the date before and a payroll on the next date. So I think you're in good shape on that. But just caveat emptor of the day is they could release guidance that says otherwise, and we don't know right now. But our position would be yes, that would be covered.
Okay.
And I do want to make this one distinction too, while we're on that topic. There is a difference of what can the money be used for and forgiveness. The money being used, because money is fungible and you're running an operating business that has receivables and income and expenses, it's really going to be very hard to decipher between the PPP money and your other money. So in terms of what can it be used for, I think it's a little bit more liberal than the actual forgiveness. So I just want to make that distinction clear.
Okay. Question, about half my employees are W-2, half are 1099. Even though I could not use the 1099s to calculate my loan amount, can I use their salary during the 8-week payback period to help satisfy payout for forgiveness?
Brandon, you want to take that one?
Yeah, and I think that's allowable, but it's not entirely clear. Again, the guidance, we're really going to have to see what the guidance says on that from the SBA. It is conceivably within the statutory language, but again, we just don't know what position the SBA would take on that right now, and I think it's a little bit vague. So.
And Brandon, I'll toss this out here. I know we have people obviously who are in the 8-week period. I know there was some guidance that came out last night or the night before last, and we would expect more guidance around the forgiveness items very soon. Have we gotten any intel on when the SBA might be giving us some more guidance around forgiveness specifically?
Yeah, we're really looking for that any day. It was hinted that guidance might be out earlier this week, but obviously that's not been issued on the forgiveness. But we expect that guidance to come out at any time. And we do know that that's the next piece in line. That's what that they're focusing on, and they seem aware at least that businesses really can't act on these provisions until they're informed. So I think that we'll have that guidance any day now, at least within the week.
And obviously, as soon as we have that, we'll create a markup and a probably a 2-pager and get that on our site quickly. Go ahead, Cami.
Okay. Can non-office related interest and utilities be forgiven? For instance, interest or utilities related to project costs?
Fantastic question.
I think it's going to depend on whether those things were generally funded by the business. So if the business funded those costs for a project or has reason to fund those costs for a project, then I think that's considered rent and utilities. The issue is going to be if there aren't existing leases in place or there weren't payments before. And this is speculation or educated speculation, but there's no telling how they're going to actually police this and to what extent. I think if you could show good cause that it should be covered, you'll probably be okay. But then again, they could be much more sticklers about this and publish guidance and tell us what we can and can't do. But if there's a reason to fund it, I would suggest that it should be fine.
Yeah, just to chime in on that one, the new guidance issued on the 14th did provide some indication for self-employed individuals and partnerships. Again, it limited effectively the forgivable amount to amounts that were deducted on the Schedule C of the for 2019. And so, if you have an expense, then that's going to be capped based on what you could claim in 2019. So one limitation that we know of is for those individuals, if you're in that category, is your expenses for 2019. In addition, it does require, and the statute does require, that you have an agreement in place prior to 2000 or February 15th, 2020. And so the documentation requirements are going to require you to show, for example, for a lease, that you had a lease in place, a written lease in place for a rental expense, and probably utility bills would be required for utility expenses. And then you need to show a link between the business and the expense. The definitive, how definitive that link is to be is unclear. And to Drew's point,
one of the things that we're recommending is, if your goal is maximum loan forgiveness, is don't win by a field goal, win by 7 touchdowns. So if between what you're doing in payroll, what you're doing in rent and leases, and maybe accelerating things, and maybe you have employees that are working above and beyond the call of duty now, and you're wanting to do a bonus anyway, you do a bonus, you pull in all these things. What you want to do if you've got one of these $200,000 loans is maybe between what you're doing, you can get your forgiveness amount up to $250,000. At least in that case, if there was an issue and a couple of things got kicked out, you might not get below your 200,000. So that's part of the advice that we're giving to people right now. So go ahead, Kimmy.
But again, I would just add on to that, Stephen, going back to our earlier point. I think that this whole forgiveness thing is almost, to some degree, blown out of control in terms of people's focus on that. And I really think, I was having this discussion with somebody earlier, I think there's really 3 camps of people. There's camp 1, which is businesses that are currently open, functional, maybe we're working remotely, but we're continuing to run as close to business as usual as possible. We're continuing to pay employees. This program is fantastic for those people. You're effectively getting a cash infusion that's going to fund the payroll costs that you would have paid anyway. The second group is those employers who are very benevolent in their thinking, and they're going to take care of their employees through this time, or at least until they can't, or just becomes not feasible. And again, this is a great program. They're doing this anyway. They would have done it without the loan. This just gives a cash infusion to help, defray the cost. That third group of employers is the one I think they need to really think hard, who have people furloughed, have people laid off. They're looking at this. They're going, I've got this liquidity. I've got this forgiveness. Should I go and spend all this money to hire all these people back? As we showed you, that is going to create a net neutral financial benefit to the business. It'll help your employees. And there may be other ancillary benefits that need to be considered, like when we do open back up, I want to make sure my employees are there to come back to work. I don't want them getting too used to sitting at home and collecting unemployment, and I can't get my employees back. So there are other considerations, but where possible, I would tell you, be very pragmatic in your business decision making. Set forgiveness to the side, decide what your business really needs to do, and then figure out, how do I maximize forgiveness within those business decisions?
Absolutely. Go ahead, Kimmy.
Thanks. Okay. Question. Could we give employees raises during this 8-week period? For instance, we were planning on giving a raise to a few employees who are non-owners before the year end. Could we do this to make sure we take advantage of the 75% eligible payroll costs?
I'll take that one. The answer is yes, as long as you aren't above the 100,000. When you cross the 100,000 in annual comp, you're going to start to lose that additional. But the short answer is yes, you can absolutely raise salaries, give bonuses, and take advantage of that.
And in that instance, you may think
one
about
additional
giving it to them more in a bonus format if the numbers can work out.
Yeah. One additional possibility is to advance salary. And so instead of paying a bonus, you could, if possible, you could go ahead, pay wages or salary for a future period. Of course, both of these options should be carefully considered.
Absolutely.
Okay.
Go ahead, Brandon. Or Kimmy.
What about the high-paid employees making over $100,000 per year? Their pay is limited to 8 weeks of a 52-week year, but maxed at $100,000 during that 52-week year.
Yes.
No, it's actually an annualized computation. So, but yes.
So in other words, Brandon, if there's an 8-week period, you can't pay them more than $8,333 times 2 during that 8-week period, or $16,666.
Correct.
You're more than welcome to, but it won't count toward your forgiveness. That's correct.
Okay. Can you pay out PTO, paid time off, to maximize forgiveness?
Brandon?
So paid time off, yeah. So paid time off, there is a careful interaction between the provisions of the CARES Act and the Family Leave and
Brandon,
and Medical Leave Act.
Before you go to the road, not having anything to do with family medical leave or any of that. I think that's they're taking more vacation, sick days, etc.
Okay. Yeah. If it doesn't, and what I was going to say is that if it doesn't have anything to do with a family leave or medical leave, then yes, that could count towards the payroll cost. If it pertains to family leave or medical leave, sick leave, then that will be limited if you are claiming a payroll tax credit for those costs.
Okay. Can you prepay vacation time?
It's considered payroll, so yes.
Yeah, that would follow the same category, the PTO. Yep.
Okay, thanks. Question, just to clarify, are phone and internet included in utilities?
Yes. Written exactly in the law.
Okay. Question, what about unemployment cost for nonprofits that pay based on claims? Can this be forgiven as a payroll cost?
Excellent question, Brandon. Do you know the answer to that one?
And that's one I do not know the answer to, frankly. There are special provisions, I will say, that apply to nonprofits, and so that would be something that probably need to look into further. But unfortunately, that's one we haven't confronted yet.
Brandon, would that not be part of the state and local tax piece of this?
It could be considered part of that, but again, that's not entirely clear. So I would hate to give a misleading answer there, but that's something we can certainly get.
Okay. Next question. It appears I can reduce salary payment up to 25% during the 8-week period and still have 100% loan forgiveness if all of the loan can be used during the 8-week period. Is this true?
Yes, but on an employee by employee basis. So you've got to look at every employee and stay within that 75% on a per employee basis. And you've got to hit the full-time equivalent to have the same number of employees as you did in the testing period. And then theoretically, yes, that's possible.
Great. Well, I don't think we have any more questions at this point. And again, we want to thank everyone for their very, very valuable time this evening. We hope this was informative. We think making the business decisions that you're going to be making around, again, as Drew touched on, whether it's maximizing the loan for long-term viability of the business and keeping that more as dry powder, or it's you're in a situation where it makes a lot of sense to maximize forgiveness. As we have more clear information, we'll be sharing that. Again, we stand ready to help. You've got our contact information here. We will be disseminating that out to everyone on the call, and look forward to helping y'all. And we will follow up and have one of these as they're necessary. Again, thank you all very much, and have a good evening.